Trading Capital's weekly analysis of all the SPDR S&P 500 sectors. So in today's analysis, we're going to look at the weekly timeframes. This is designed more for investors, but it does also give traders a little bit of an edge to overall see where the major resistance and major support levels are pending. So right now we're looking at XLK. XLK is the technology ETF, which does have the big heavyweights like Apple and Microsoft that carry a massive amount of weight in most of the indices. So if you look at the XLK, pretty pivotal point for the XLK, we've now hit the weekly 100 moving average. This is a long-term upsloping trend that looks to be trying to curl over. Technology is at a massive inflection point. If technology loses this area and this long-term moving average starts to curl over, we could be in for a scenario just like we saw here, where you have the upslope in the moving average continuing, which gives you that longer term trend. If this moving average continues to slope down and roll over, we could be in for a long grind down in technology. So it's really going to be interesting to see how things shape up. Basically, what most people have been anticipating is a breakout of this downsloping trend line. Now, you have technically broken out of this downsloping trend line, but what a lot of people are trying to neglect and fail to realize is that we have not confirmed above this weekly hammer candle. This technical top is still in place until we get a secondary week close above that. Now, the short-term positive for the bulls is often you see price action want to go to this gap fill and fill major gaps, especially since it is a weekly one. But we're going to have to really see if the likes of Apple and Microsoft can lift this market. I mean, if you look at Apple's trend, it is peaking above that weekly 100, remaining very strong in compared to most of the tech. If you look at Microsoft, which is the second 100 weighting, it's also still coming into some resistance here, so hasn't quite touched that weekly 100. So a little bit of mixed divergences across the tech sector. Moving on to the XLY, XLV before we discuss that. XLV is the second largest sector, healthcare. Basically for healthcare, you had your initial hammer, bearish consolidation. The short-term positive for the bulls in healthcare is that you're most likely seeing a rotation of capital. If you look at this down sell in healthcare, it was a very trickle-down selling process. And this type of pattern shows that there's actually money rotating out of healthcare because most of the names such as Eli Lilly, you also have Regeneron, Johnson & Johnson, United Health, they were bloated. And you actually saw a big sell-off in those names, which brought them down to more reasonable levels. Now, with healthcare, with this money distribution rotating out of healthcare, you clearly saw the money rotate back into technology, which I'll show you here. So technology had this powerful move up, and healthcare had basically a trickle down rotation. So a lot of this funds rotated into technology. But the short-term positive for healthcare is that you did make this weekly doji candle. Basically, you haven't confirmed a break of this bear flag channel. So until you do that, this ultimately could try to recapture the channel, since you can see that you did have heavy volume here closing the week on the Friday. And basically you did put in a weekly doji candle. So we're going to have to see. It still is very vulnerable. Well, you can basically see the difference between this process here is that most of the healthcare sell-offs happened in a quick, sharp fashion, sharp fashion. This one's just been a slow grind and bleed. So it kind of leaves me to suspect that we're either going to have a big snapback into the upper ranges of this channel, or we're actually going to have a larger breakdown. Now, if I was to lean towards more one side or the other, I would favor a large breaker down to this 126 level where you have major support. Obviously, there might be a little bit of an intraday bounce off this 128 level. It is a weekly 100 moving average. But notice how you've hit the weekly 100 moving average here, went above it. You only stayed 1 week below it. You hit it again, you basically stayed 2 weeks below it and rallied. Now, this next time that we hit it, we likely will stay deeper than any of these two previous periods because you've tagged the support multiple times. If we look at some of the stocks like J&J, the leaders in healthcare, you can see that J&J has pierced the weekly 100 moving average, which this is the largest stock. So you would favor that the XLV likely sees more downside to the weekly 100. UNH, same sort of thing, hitting the weekly 100. This one's interesting because you do have a little bit of a mini M-top formation that's on watch. You have to break this key trend line over here, and confirm below it to see this pattern downside to 368. But that would be a pretty nasty topping formation on UNH, which is, I believe, the second largest weighting in XLV, which would obviously favor dragging XLV down. If we look at XLY now, XLY, the consumer discretionary, has had a pretty powerful move off the lows. Basically, you can see that it is now officially tagging resistance, COVID low, pivot in the summer, chop, consolidation, rejection, and you've retraced to that area. You also have a perfect symmetrical parallel channel. So what this tells me is that if we fail and reject off of this level, then it likely means we're going to probably either test the double bottom lows here or even pierce and head to the low range of this parallel channel. If we look at some of the XLY stocks, consumer discretionaries have about 11% weighting in the S&P, so it's a decent size. And then if you look at some of the names, like Tesla has a pretty decent weighting. If we pull up the Tesla chart, basically Tesla has about a 13 or 14% weighting in this indice. Tesla's had a sharp move off the lows, which does correlate with the XLY breakout and parabolic move up. And we also have names like McDonald's, which are showing weakness. A couple other bigger weightings in this ETF. You also have Nike, which is a fairly decent weighting. Home Depot, Amazon. If you look at Amazon, Amazon's going to be a leader for this particular sector because it is the largest weighting. But Amazon's weekly chart is pretty nasty. You had a massive move up to the highs here, hitting this downsloping resistance trend line and completely reversing, putting in a weekly hammer reversal candle. Now, most people will say, oh, this is still a green shoot. It is, but the fact that you went up so high and you have this tail that is extremely massive, closing inside of that previous wick on extreme amounts of volume, shows that this likely price action is going to continue to go lower. If you see another secondary trend line, we hit this pivot to pivot to pivot. This was basically the major trend retrace. If Amazon was to recapture it, you likely would have seen continued upside. The fact that Amazon has failed at this level, you likely go and test the lower boundary level here. Now, I'm extremely bearish on Amazon. One of the reasons why, if we simply do a little bit of a trend analysis pattern here, basically following this white moving average, this weekly 100 moving average, look at that powerful uptrend in that weekly moving average. It's very rare to see Amazon's moving average start to slope over. We saw it here with a quick rebound, but the difference between these periods is we didn't experience QT and these forms of high interest rates really up until this 2000 cycle and in 2008. And you can see once that moving average started to slope over, which it kind of looks very reminiscent of this period, you had a deep sell-off. So unless the central banks continue to print and start stimulating and easing up on their policy, I do think that Amazon is likely going to be in some trouble with this long-term moving average starting to bear down in a very vicious downtrending slope. So obviously with the moving average now crossing down, you can slowly start to see it push lower, especially if Amazon remains weak. Let's take a look at communications, which is XLC. So in terms of XLC had a massive breakout. This was led by Meta. Meta is the largest weighting in this index, followed by Verizon and Alphabet, so Google. So Meta was obviously the standout in terms of it, but Meta's hit some decent resistance over here on the weekly chart. Once again, Meta's long-term moving average, the weekly 100, is also starting to slope down. It's been very rare that we've actually broken that level and it starts to slope down. I mean, if you look at Meta's chart, it really hasn't had a period where the moving average has started to slope down. You had some choppy, turbulent periods here, but even this little slope was still upsloping. And now this moving average is clearly in the downtrending slope, so it does favor lower price action, especially when you favor this extremely overbought move. You know, going from basically 89 all the way to this doubling is an astonishing move on Meta, but I do think that it's going to put a lot of pressure on this XLC. You can see the resistance that XLC is at. You just closed on a weekly basis above this pre-COVID high. Now the big question is, can it confirm and build a base from here? My likely thesis is that it pulls back, consolidates to see if it can actually hold this level. If it can't hold this level, then you likely fall all the way back down to 51.87, which would imply a big move down in Google, which would also imply a big move down in Meta. So we have to continue to obviously watch and see how these things start to participate in uptick. In terms of Google resistance, you can see that Alphabet is trading around these wick lows. basically, if you draw a little bit of a trend line through here, you can see that it tagged these levels. You had multi bearish consolidation of weeks here of price action, which actually broke down. So in terms of Google, it's most likely going to have to consolidate at these next support pivots here if it stands a chance to build a base and break up. Now, if we see a vicious downturn breaking these first key supports around the 100 level, that's going to be bearish for Google. You really want to see Google now flag sideways in and around between this 108 to 100 range, but ultimately holding a weekly close above 100 so you can see the XLC move up. In terms of the next sector, XLF, the financials. Financials are interesting because they hold about a 9.8% weighting in the S&P 500. In terms of financials right now, on the technical basis, you are closing above this weekly 100. So the reason why the strength in financials has been so powerful is look at this moving average, this long-term moving average. It's been in a slow uptrending pace, and you pierced through that, had a bounce off of key support levels, this pre-COVID high here, and basically right now, it looks to be that this is potentially going to start rolling over or lose momentum if the XLF doesn't make a break very soon. You can see the XLF is still at this pivot and you haven't been able to close on a weekly basis above and confirm that. So we'll just have to see if we can do that. Now, the thing about this XLF, which remains skeptical about this breakout, is if you actually look at the volume periods here that we're now trading into, this big chunk of price action, you're going to need a larger amount of volume to basically eat through these shares and break through this price, which is why I remain skeptical of financials trying to make a breakout to the upside here. In terms of some of the financial stocks, JP Morgan has about a 10% weighting. So if you look at JPM's basically been a powerhouse. You did fill this weekly gap. So in terms of upside price, it's very likely that we've fulfilled the upside measured move. And again, you're now trading into these large volume periods where the price action sold off. So you can see the same seller that sold off on this 2 weekly bar surge down, the same seller was also present in this 2 weekly bar surge, and it was also likely present in this 2 weekly bar surge. So you're starting to come into this sell side pressure where JP Morgan really started to vigorously sell to the downside. So this is a massive, massive level. And again, you're closing above this weekly 100 moving average, but it's on the cusp. It really needs to hold this price action, start trending higher, because if it doesn't, this weekly 100 starts to roll over, then that means the trend, once again, the long-term trend is in jeopardy of potentially falling over to the downside. So certainly lots to watch. A couple other banking stocks that are significant to watch. Bank of America in this XLF sector is pretty interesting too. If you look at BAC, BAC is trying to break out of this basically this wedge pattern here. It hasn't confirmed, so we have to wait for that signal. But once again, BAC is remaining weak and trading under that weekly 100. And the big question is, does it want to go up there and touch that level before rolling over? Or do we start to see this resistance trend line come into play and a failed confirmation breakout? Lots to watch as we move forward. Industrials is an interesting ETF. If we look at XLI, industrials have about a just under 8% weighting in the S&P right now. In terms of the industrials are actually trying to break out here. Now, you did get a weekly close above this trend line. As we can see, it's peaking above, but you still haven't been able to close above this wick high. Until we get confirmation above this hammer candle, I remain very, very skeptical of industrials. Although this sector has been the leading stock because you've had the likes of Caterpillar in there that hold a massive weighting, but that's starting to see some weakness on volume. Look at this volume that just came into Caterpillar on last week. I mean, after literally hitting some massive, massive technical resistance levels. I mean, we have pivots going from 2006 to 2011. You kissed this in 2018, and then you're basically piercing that level now. I mean, so there's massive resistance here. This is a broadening formation, so it remains semi-bearish, but this volume is incredible to see on Caterpillar, and it just means that there was a lot of buyers still trying to buy these highs, which is kind of a little bit crazy in my opinion. I mean, Boeing, you're also seeing Boeing potentially starting to put in a weekly reversal signal. This is a weekly topping signal on Boeing, which likely means we've seen the high in Boeing and we see a retrace to the next support, probably around the 185 level at the minimum. But Boeing's moving average is also slowly, the weekly 100 is sloping down. You did manage to close and confirm above it. So the big question is, Can we build a base above the weekly 100 moving average to bounce off of? Or will we eventually lose that and start to trend lower? A few other stocks in this sector that are important to watch are like Raytheon. So the war stocks, RTX is the ticker for Raytheon. So if we look at Raytheon had this massive wick high and sell off, failing to close above the previous pivot high. Does look vulnerable right now, Raytheon. You had this initial upsloping move, which broke down. You had a retrace, try to pierce up, made a new high, and then you got sold back off. And now it looks to be like you want to roll over on Raytheon. So in terms of Raytheon, if you take out these pivots here at 93.75, then you likely retrace back down to 87. So that's important to watch for the industrial sectors as well as the war stocks and where money's flow is going. Next sector is the XLP. So consumer staples are interesting. I'm extremely bearish on consumer staples. Consumer staples had this bullish potential formation trading inside of this weekly reversal signal. And this bullish consolidation has actually failed. And now you're putting in bearish consolidation on the weekly. You've now had 2 weeks of consolidation on the weekly, basically trading at a little bit of support. But the longer you consolidate in this range, it does favor a break lower. The big level I'm watching is a weekly close below this trend line. If you lose this trend line, you likely head back down to the low end of this range. On the daily chart, there is kind of a bearish topping formation here. You have a left shoulder, a little bit of a head, and a right shoulder formation. So this is a big level to continue to hold, but this is bearish consolidation for the consumer staples. Consumer staples hold about a 7% weighting, often seen as defensive sectors. You have the likes of Clorox, Procter & Gamble, Pepsi. If you look at PG stock has actually been hit pretty hard with these last 3 week sell-off. Now, the importance of Procter & Gamble is because it has a 14% weighting in the consumer staples XLP ETF, is that you've came here, a sharp sell-off into the weekly 100, major support, had a mini bounce, sold off again, closed below it, and then you've had a little mini bounce last week. The fact that the bounce has been so weak and still really closing at the low of this bar over the last 2 weeks, this is bearish consolidation potentially forming on Procter & Gamble, which does make me very concerned because consumer staples are the necessities that people need. And could this be the signal that, yes, although we're getting mixed signals in the labor market, it still means that people could be cutting back? Even if you look at something like Pepsi, Pepsi is interesting because it does hold about a 10% weighting. Pepsi is putting in weekly bearish consolidation. Pepsi is an interesting chart because I want to show you a couple key trend lines. Basically, it shows that Pepsi is tagging this potential support now. You've tagged support now 3 weeks in a row with a very minimal bounce. So since the bounce has been so minuscule, it does favor that once you get that weekly close below this trend line, you likely see more downside. You will have some support around this trend line over here. So that's why you're getting this little bit of a consolidation on this area, because there is support here, but the bounce has been very minimal. The sell side volume is slowly upticking. You're on a 3-bar nice surge to the upside. So the big question is, do we get a flush? The major support where we could play a potential technical bounce on Pepsi is around this weekly 100. That will be a big level. The last time we hit it was all the way in March or in February of 2021. And look at the epic bounce we had off of that level. So Pepsi is certainly interesting to pay attention to, as well as Coke. KO is the ticker for the consumer staples, but Coke is also putting in bearish consolidation. You break this pivot around 59.40 on a weekly basis, and it looks like this sector could trend much lower. XLU is interesting because XLU Utilities is trying to break this key trend here. This upsloping moving average, the weekly 100, is slowly potentially trying to run out of momentum. So if we lose that area, you likely see much lower price action. Real estate is going to have a big adjustment to the spike that interest rates just had. But if you look at real estate, XLRE just tagged that weekly 100. You still could potentially go a little bit higher, but I do find that difficult considering interest rates had a massive spike. XLB, the material sector, is still trading under resistance inside a weekly hammer. So it does favor the potential downside price action. Despite this being a little bit of a bullish pattern setting up, you have weekly hammers starting to form across all of that. XLE is interesting because I'm extremely bearish on energy just with the overall divergence in natural gas and oil. XLE is trading right at support. If we lose this trend line, you likely test this low pivot at 81, gap fill at 79, and then the larger gap fill to the downside. If you look at charts like Chevron, they are remaining bearish. Overall, many of the sectors are at resistance, which does favor downside price action. So we'll just have to continue to see how the charts wrap up. Take care, everybody.